Hello, my name's Carl Mitrak. I've been a realtor for 47 years in California, and I'd like to share with you some things that I've learned from a lot of people that are no longer in the business, generally because of their age. There's a saying, old realtors never die, they just get listless. Well, these people got listless and died. I took the course from a title company, Stewart West Coast Title, in the early 80s when interest rates were going for 14 to 18%. The standard rates at that time was 9.5. So a lot of people were going out of the business because they couldn't get buyers to agree to acquire a property. So when I took this course from Stewart West Coast Title, I learned how to do all kinds of interesting things that we call creative financing. I learned how to do alternative financing, which is also called creative financing, junior loans, land contracts, all-inclusive deeds of trust, the benefits to lease options and conveying title. And of course, there's disclosure issues, which we have a lot more than we did in 1982. So it kept me alive. It kept me in the business. A lot of my friends went out of the business. A lot of the people were afraid, or the brokers wouldn't let them do what we call creative financing, and it was a detriment to the buyers and the sellers. Sellers wanted to get out of a property, and buyers wanted to buy. So alternative financing is also called creative financing. With creative financing, generally you have junior loans, and I'm going to share with you how to blend the interest rate. I'm going to discuss the benefits to a lease option and the detriments to lease option, because I think there's some detriments. We'll discuss the all-inclusive deed of trust that has lots of different acronyms versus a land contract and disclosure issues. So you ready to get started? Creative financing, it is an emotional. You're taking people out of their comfort zone, their experience, the experience of their mom, their dad, their grandfather, their neighbor, whether it was a negative experience or a bad experience. You're dealing with the emotional opinions of others. Sometimes it's attorneys, sometimes it's attorneys that are good attorneys, roasted attorneys, or attorneys that are maybe a family law practitioner. They may not have the scope to know how to deal with creative financing. In fact, in the 80s, I sold a 6-unit building, and we did a wraparound mortgage around one of my good customers was the buyer. It was a divorce situation. The attorney for the sellers had me go to the divorce attorney. He didn't even know how to write up the all-inclusive deed of trust. He had me do it. He got paid his $5,000, but I did the work. Oh well. So creative financing. It's emotional. I had some people one time, they carried back a $5,000 second on a building in San Clemente, and they were all bummed out because the buyer sold the building to somebody else who then defaulted and lost their $5,000. In fact, that guy used to be an electrician for the Nixon White House, Western White House. So it's a catch-all phrase, creative financing. It's no specific meaning. It doesn't have a legal meaning. It's usually used when new loans are not possible. It has a different meaning to everyone. The principals ask usually, what is my level of risk? And you must be honest with them. You have to tell them the consequences, positive and negative, the risk. Historically, creative financing, alternative financing, was used for large commercial industrial properties when financing was not available. Interest rates were high. Loan fees were high. Some commercial loans, when we had 9.5% house loans, the commercial loans were 13.5%, 14%, and the lenders wanted what we call, quote, origination fees, points, sometimes 3 or 4%. So you're doing, say, a $500,000 commercial building, and you have, say, a $400,000 loan at 4 points or 3 points, you get a $12,000, $16,000 loan fee. And people wanted to circumvent that. Historically, when there weren't banks, sellers carried bad paper. Historically, these things, the all-inclusive deeds of trust, contracts, it trickled down to the smaller properties that we use now, houses, sales, duplexes, fourplexes, etc. Junior loans. Junior loans are called liens. They're called notes. Some people call a junior loan a trust deed. The trust deed is actually the document that generally gets recorded. It doesn't have to be. That basically is a security instrument for the note or the liens, meaning that the document that's recorded for the whole world to see tells you that there's a deed, that it's a deed of trust, and there's a note somewhere. The note's generally not recorded. The lien's not recorded. That's in somebody's file. But the document tells you, hey, we get a deed of trust. So the lender says, okay, you're gonna pay off that junior loan. I need a copy of the reconveyance on the trust deed. Then the party, the trustor gets the note, sends it off to the escrow company, and it gets paid off to the title company. So junior liens, junior loans, notes, trust deeds. Usually it's the foundation of creative financing. So junior loans could be a second, could be a third, could be a fourth. Think about it as stacking bricks, and the reason I'm giving this analogy to you now. You'll see it a little bit later. So say you have your first loan with a bank, best bank in the United States, and from there the seller carries back a second, so that loan becomes a second deed of trust. I usually go this way: first, second. Now let's say Aunt Molly is going to put up the third for 10 grand. And then you're going to do some restructuring to the property, and you go to your sister, and she gives you a deed of trust and a note for 5. So now you have a first, a second, a third, and a fourth. When the sister gets, let's say that Aunt Sally or Aunt Molly down here that loaned you 10, 12 grand, her third gets taken away. She gets paid off. That little loan with your sister drops down to the third position from the fourth. The second gets paid off, but little sister keeps her little loan. Now you have the bank's loan as the first, and the fourth loan has dropped down to the second position because the other 2 loans have been paid off, and the trustees in California get reconveyed off by title. Maybe in your state you guys don't have trust deeds. You may have contracts, or you may have mortgages. So junior loan, lien, note, seconds could be a first, second, third, fourth, and you could even wrap around that with an all-inclusive deed of trust that we'll get to later. So junior loans were used before we could get 90 or 95% loans. You'd have a seller do a carryback loan for 10% usually. So you get an 80% loan from the bank, you get a 10% loan from the seller, and you would put 10% down. So $350,000 property, $35,000 down, $35,000 second. I'm not sure what the 80% would be. You have to figure that one out. Keep your calculator out, by the way. Get it out for you. Take a break. So what do? Now we have 95 and 90% loans. Of course, you have principal mortgage or MMI mortgage insurance with it. However, these aren't as prevalent because now the banks are making 90, 95% loans. We're going to see how that's going to play out in the future. That's why we had such a big property discount and dilemma with the recession of 80, because these lenders were sometimes not only loaning 95% loans, they were loaning 110% loans with people not having to substantiate their tax returns. So you buy a property, you get $35,000 back from the lender, and people split the country. Hello? God, why'd they do that? By the way, during my career, I've never done a 95% loan. It's always been some 90s, used the 80-10-10s, or my buyers have more down payment. There are clauses you can acquire and put in your note to protect the parties when you're generating the party, the seller, the buyer's agent are generating the note. You can put customized clauses in to fit the needs and emotions. Generally, they are not enforceable. You have standard clauses that protect all parties that are enforceable. 9% interest, paid interest only, due in 5 years, a due on sale clause. You can't put more. You can't pay more than 80% of, 20% of the loan off per year. That's a principal reduction. So that would be like a standard clause. Then you have sometimes you have to put a customized clause in there. And a customized clause could be, I'm gonna carry you back a second. I'm gonna loan you the 20,000. However, if you're gonna sell the property, I want first right to buy it or refusal to acquire the property. That may not be an enforceable clause, not on a note. There's other places to put that. Or you could say, hey, I know your wife has 2 children. You want to have 3 more. If you have 3 more children, I'm worried you're not going to make the payment before you have your 3rd baby. I'd like to get paid off on my note, or have you pay me down 50% of the balance. That's not really probably enforceable, but it may allow the buyer and seller and the lender, whomever the lender is, it's not the seller, to agree to the contract. Seconds, notes, liens. Liens are more of a general term. They're used to balance the equity. Obtain a first loan, then you get maybe a second because you don't have the down payment. So you do that, and when you do that, if you do an 80-10 loan or a 70% loan and a 20% down or a 10% down, you do not have to have the principal mortgage insurance generally. Generally, mortgage insurance is required by lenders that make the loan of 90% or more, sometimes 89% or more. So there's mortgage insurance, usually that's another 0.5% of interest. Now, up until probably 15, 12 years ago, once the value of the property came above that 90% loan balance, you could get the mortgage insurance taken off the loan. I do not know if that is now the case. Maybe now they want you to refi. I've heard some stories about that. So let's give you some examples. Here's the ideal situation. You buy a property for $320,000. You put $32,000 down. You get a 90% loan. You pay PMI. Let's say that you have more down payment and you don't want PMI or some other issues popping up. Another way to buy the property would be put $68,000 down. Get a $210,000 loan. Maybe the seller wants to carry that $210,000 loan. They don't want to be paid off because they want that for a retirement income. However, they'd like to get $10,000 in 2 or 3 years. You can either put that $10,000 into the note that is to be paid off. It would be enforceable in, say, 2 years. Or you could do a second. Or you could go to Aunt Sally. Hey, Aunt Sally, want to loan me 10 grand as a second on a property? Sure, you're going to put $68,000 down, Carl? I'll be glad to do that. So that's kind of how that works. So have I done a lot of this stuff? Yes, in the past. I'm sort of, you saw my first page, I'm actually a dinosaur in the business. I've done this for a very long time. I'm in my 47th year selling real estate, and I'm worried that many of you, buyers, sellers, realtors, by the way, is a 2-syllable word, not realtor, not 3. And if those that you don't know that are in the public are reviewing this, not all realtors, not all real estate agents are realtors. Realtors subscribe to a code of ethics. They belong to a local board or association, a state, and a national, and their broker belongs to the association. Some real estate agents are not brokers, meaning a broker to the set that they work for. They could be a salesperson working for a broker, or they don't belong to the code of ethics and belong to an association. But many times, just like a Xerox copier, we all use the word realtor. Well, maybe your copier is a Samsung, but I'm going to go make a Xerox. Same thing with the word realtor. Real estate agents that are not realtors, they're violating a copyright rule by saying they're a realtor. But this, sadly, the public doesn't care. If a seller on a note charges too low of an interest, the IRS will charge an applicable federal rate. Or the safe harbor rate was 9%. I'm not sure what that was now. So you got to be careful. If you're going to do a second, sell your property to your son or your daughter, and you're going to give them a note for 2% for 3 years interest, the IRS may come back and say, hey, wait, you have an imputed interest rate rule of 4%. They're going to charge you income tax on 4% or 5%. So I don't want to say be safe because I did this class a long time ago. Have seller carrybacks at notes at 9%. That's not really what you need to do, but you just need to find out what the short-term, middle-term, or long-term federal rate is. It's go online and Google AppleGo federal rate, and you'll get it. Make sure you at least charge that, or the IRS is going to charge you a fee. That's not a lot of money if you're doing a $10,000, $20,000, $30,000 deal. But if you're doing something that's bigger, say a $300,000 carryback to your son, and you charge him 2%, and the short-term rate on the 3 to 5 year loan, you figure that one out, and it's say 6% or 5%, you're going to be paying a tax on the difference of 3%. Over 300,000, that's going to be that's not, you're going to pay tax on $9,000 that you may not have acquired. You won't pay the $9,000. You'll pay it by your percentage of your liability. Blending the interest rate. Here you may want to have a pencil and paper if you want, or your calculator. Blending the interest rate is when you take a first loan. Let's say the loan amount is $300,000 and the interest rate is 4%. You get the annual percentage, the annual interest, APR, annual percentage. There's no APR fees. There's no extra fees if it's a private loan. Let's say you have a second loan, and it's a loan amount, and it's going to be a seller carryback. Let's say it's $30,000, and it's going to be 8%. So that's what, $2,400. So you take the total principal of both loans, or the 3 loans, or the 5 loans. You get the total interest rate for each one, right? So 3% interest on the $300,000, $9,000 a year. Say this is a $5,000 second at 4%, that's $2,000. You add up the interest. You divide the interest by the loan amount and you get the rate. Why is this important? Because sometimes you're going to get a party that's going to say, I don't want to pay 9% on a loan. Come on, that's not fair to me. Well, if you take the $150,000 loan that's say 7%, and you take the $30,000 loan that's 9%, you blend the rate of the 13.2 total and the 180 total principal. Yay! Your actual rate on the combined loans is 7.33. If this loan is already on the books or a seller carryback, you don't have to factor in APR financing charges. So 7.33. I'm okay with that. So that's a good tool to use when you are a buyer and you're going to acquire something with the seller's financing, or if you're a agent and you need to convince your buyer to buy the property, because that's the rate, even though they get a 9% loan. Makes sense? Take a moment for that if you'd like, and try to calculate that in your computer. Maybe write it down and keep that in your briefcase. When to sell with existing financing. When do you want to do that? When there's no equity? Hey, Carl, I want out of this property. I refied it. Even this one happened to me where I picked up a property where it had a reverse mortgage and all the funds were used. The lady says, hey, just get me out of this. I just took over the property, took over the loan, rehabbed the property 3 months later, sold the property. I paid her, I think, $15,000, $20,000 and took the property, put money into it, resold the property, paid off the loan that has due on sale clause on the reverse mortgage. So a drop in value, the property is overfinanced. You're going to see a lot of that probably now when we have this downturn in our economy. Today is the second day of fall, I think. So we're going to see some changes now that these interest rates are going higher. We see a lot of stuff coming on the market. A lot of things aren't going to be selling because people are back 2 months, 3 months on the values, and values are dropping. We've already had a drop where I'm at in the desert, Coachella Valley, Palm Desert, Palm Springs area. We've already had a drop from the month of August of 2022 compared to the August 2021. There's been a 10% drop in values. I think it's going to go to 30%. In 2008, Riverside County, a lot of the areas dropped 70% in value. So when do you sell with existing financing? When there's no other option. You get a time bomb. You need debt relief. Possibly your loan's in arrears. You lost your job. You've lost your income. You have a divorce, a sickness. There's no other options. Natural or man-made disaster. 25 years ago, we had the Northridge quake in California. What's going to happen now? We just had the Hurricane Iona past week, because it's October 2nd, 2022. How many of those people that own their houses clear have damage and don't have hurricane insurance? Lenders require hurricane insurance in many parts of Florida. What if you didn't pay your policy amount? It takes the lender 6 to 8 months to follow up, to check their records to see that you have insurance. Who loses there? The lender and the seller, the owner. Existing financing. When to sell with the existing financing and you had carrybacks or etc. When there's high interest rates. We're going to see this happening now. Right now we've got 6% first, and people have loans they picked up 2-3 years ago at 3%. That's one reason why I'm putting this course up now for you to learn how to do this, because what you can do if these go up higher, people are going to want to take over those loans. If people bought a property, say a year ago at 3.5% rate, they got a 90% loan, and now the values drop by 10%. So they basically have 100% financing, and you want to buy that property, you can come over and take over that loan. The lender is not going to let you probably assume the loan unless it's a VA or an FHA loan, because the loan's probably going to be non-assumable. So what do? You take over the loan. So loan is fixed and it's not assumable. Other reasons: no programs available with a low down payment. If the seller will do a carryback, you can get outside financing for a second or a third from a hard money lender. You could probably buy the property for a low down payment, get out of the property, the seller gets his equity, and you have a first and a second. Poor condition. There's deferred maintenance. A lender won't loan on the property because you've got termite rot. You've got other issues. You've got a bad roof that sagged the kitchen. You've had a flood. You've had a bad pipe break. There's no loan available until repaired. So you do existing financing or creative financing with optional alternative financing tools. It's a temporary solution. I've had a situation in the past, this will kind of blow you away, where I had a party of my lady that was a dear friend of my ex-wife. They had gone to college together. We were married at the time. And her husband lost his job, and they were defaulting on their house in San Clemente. I brought them an offer with a one-party listing contract for me, for a buyer that I had to buy the property and take over the existing loan. Not assume it, take it over. This lady, the woman seller, with her husband, the selling woman, she called her dad, who worked in Arizona, and he was not a real estate attorney. He advised her not to do it. Don't let them take over their loan. That's illegal. No, it's not illegal. You can't do that. They didn't do it. They lost their $65,000 of equity. The bank foreclosed on the property. It came back on the multiple listing service. I wrote an offer for the same buyer. He bought the property, and his wife, they bought the property for $70,000 less than their previous offer. Lease options. I stay away from lease options because what a lot of people don't know is a lease option is over 1 year. The lender can call the loan due. Just like they can call a loan due on sale clause if you sell the property without them allowing an assumption. Many times if you've got an adjustable loan that you also may call a variable loan, many times those loans are assumable. You got to check your loan documents for that. Benefits to the buyer to purchase something on a lease option. Number one, they get a set price. Yeah, well, that changes later, sure. Okay, there's no qualifying with the lender. They can walk away from their option money if the value drops, or if they damage the property, or alter it. And I've seen that happen. I have a friend, he sold a house on a lease option. And the new tenants, because they're really just a tenant as an optionee, they decided they wanted to take off the roof and raise the ceiling in the kitchen. It was a Spanish house in Long Beach. Remarried to him. And we had a rainstorm. They didn't cover up the roof. The house flooded. They walked away. My friend, who was the optionor, or you call him the landlord basically, he had to come back and repair the house for about $40,000. Detriments to the buyer. What if the value increases and the seller can say that the buyer defaulted earlier because you missed one payment or you paid late and they want to get out of the contract? Many options have a default clause if a payment is late. The buyer must maintain the property without any tax benefits. They don't own the property, so they can't get tax benefits. There's no write-off for the interest or the taxes. So all they have is a promise that they're going to buy something later. And you got to figure out if they're going to buy something later, it's kind of like going to the store and putting something on layaway. Why? You can't buy it, you can't qualify for it now. You don't have the credit to qualify for it. So lease options, usually there's a reason why you get a lease option. Be careful with the lease option. I don't do them. What if the seller doesn't make the payments? You put up $30,000 on option money and the seller didn't make the payments on his loan, or he goes bankruptcy and he gets foreclosed on. You as the optionee, the tenant, the buyer, quote, you're out. And if somebody wants to play a game and they want to play a due on sale clause issue for the lender, tell them the property's been been leased over a year. That's why most leases on property that are residential or small buildings have only a 1-year lease. When you get the commercial properties, the big loans, they don't really have such a big issue with option money on leases. So disclosures. I always tell everybody everywhere to check the loan documents. If there's a due on sale clause exists, notify all parties. And I put that actually in my disclosure statement, that the loan could be called if the lender is alerted that there's a lease option or a lease over 3 years exists. Explain you are not an attorney and they should consult with one now. I usually just modify this disclosure phrase and I put it in my other disclosures, financial disclosures, purchase agreements, escrow instructions, so it's out there all the time for the buyers to see. Benefits to the seller on a lease option. It lowers their monthly payment, lowers their liabilities. If the tenant, the optionee, pays on time, the seller doesn't maintain the property. The tenant does, the optionee does. Usually the seller retains the tax benefits. Detriments to the seller with a lease option. Buyer may damage the property and walk away. I talked about that. The loss of capital to work with. Oh, if I sold the property, I could have got maybe $60,000 down on my equity, but I did a lease option and got 10 grand. Well, now you're out 40 grand that you don't have until the option is exercised, which could be 1 year, 2 years, 3 years, 4 years away. Your liability, you still have a liability on the loan. The buyer could quit making payments after he's messed up the property because he doesn't like the barking dog next door or the drunk across the street that revs his car early in the morning when he turns the radio on the speaker blasters, and they want out. So they want to get out of the property. Or the value drops, the buyer could default. Say, I'm not going to do the option. And now you're going to take it to court because you got to evict the tenant. What happens to us as the agents is that we don't get paid our commission until the option is exercised. That can be 1, 2, 3, 4 years down the line. Worse than that, usually when it's time to exercise the option, somebody is upset. The property went up in value, the seller's mad at you. I don't want to pay you all that commission. I lost $80,000 in 3 years. The price went up, or the price goes down, just like we're going to start to get stuff going down in value now. The buyer says, "Oh, I don't want to do that. I lost my option money. Let's say I put up 10 grand option money. The rent should be about 3 grand a month. I'm just going to sit here for 4 months and not many payments and let you evict me so I can get my option money back." How do I know these things, people? Because I've seen it happen to me, or my friends, or my clients, or my brokers, other agents. Detriments to the seller, I mentioned that. You got to negotiate the option terms. You're not paid until the option is exercised. The price goes up, the price goes down, you're back negotiating. Vehicles for alternative financing. The loan assumption. If you can do a loan assumption, do a loan assumption. You don't need to know anything about this course. Do a loan assumption. Go away. That's the best thing to do. There's no risk. The loan's approved by the lender. You've got to have the amount down that the lender requires. Usually they're going to hit you for a couple $100 service fee. They may charge you a 1% loan cost. 1% on a $300,000 loan is 3 grand. The buyer assumes the liability, is qualified. However, if you want to do a quick transaction, it's not going to happen because a loan assumption is not a priority for the lender to process. They want to take their time and process their loans, new loans with new interest rates. And if your loan, and they may not, they can even try to work you to adjust the loan up, the interest rate a little bit. However, it's not a big issue for them if they're getting payment on that loan when they can go out and process new loans at a higher rate or another rate. So you want to kind of keep that in mind a little bit. That sometimes I've even done a quick subject to the loan and then started the assumption process when the lender tells me it's going to take 180 days because they're understaffed. So alternative financing, loan assumption, benefits to everybody, even the banks. When you can, do it. Do an assumption. When you can't do it, there's other things you do when you can't hit that same great target. Subject to the loan is high risk. The bank is not aware of the unauthorized transfer of title. You're taking it like an apron and you're hiding the fact that you have a different buyer. It's imperative that you disclose everywhere except to the bank that the loan can be called due and payable due to the acceleration or alienation clauses in the note. Or we call that the deed of trust documents or loan documents. You probably call it your mortgage documents if you're out of California. Always recommend in the purchase agreement, if you're a buyer or if you're an agent, real estate agent, escrow instructions, seller financial solution, that the loan can be called due. Let them know that there's a due on sale clause. Urge, recommend that they get advice, principles to a legal advisor, a real estate attorney. Generally a real estate attorney will solve everybody's issues, your broker's issues, the buyer's issues, the buyer's wife's issues, the seller's issues. I always them to do and have a good. You should know a good real estate attorney in your area. It's good to have a rapport with one. In fact, you maybe want to send all the real estate attorneys in your area a card and a letter of introduction. So when they have somebody that comes to them for the transaction, you can possibly work out some kind of a referral agreement, or obtain some kind of a working relationship with the attorney. Well, good ones to do that with would be probate attorneys. Most fixed loans, unless VA or FHA, are not assumable. The due on sale clauses protect us from low interest long-term loans. they may be higher costs to borrow from someone else. So what I'm saying to you that, let's say that how does a lender get protected by a due on sale clause? So let's say that they now have 1,000 loans at 3.5%, and now the interest rates are going to 6%. They get a higher override on what they are charged by the federal government to borrow money to the loans that they are loaning out. So why do they want to borrow money from the feds for $300 million when they have these little loans down here that are only have a 3% interest rate? They want to get that money back out at 6% or 5%. So that's why they have a due on sale clause. They don't want to be stuck with a loan for 30 years at 3 or 3.33 or 4% when the rates are going up to 6, 7%. They're losing profit. That's why we have due on sale clauses. And they want to ensure that the buyer that they have is qualified for the loan. And they don't know if you do it subject to the loan if the buyer is qualified. Probably they aren't, otherwise they do an assumption. Benefits to the buyer when you take over subject to the loan. There's no qualifying. They have damage credit. They can buy with a loan down payment. They have poor ratios. It's fast. There's no assumption fees. Retain the existing interest rate. They're not liable for the loan in the case of the default. Who's liable? The seller is. So then the seller goes in 4 or 5 more years or 3 years to get a new loan somewhere else. Hey, you had a foreclosure 3 years ago. Yes. Generally, you can substantiate it. Here's what happened. I sold this property on a land contract or all-inclusive deed or trust, and it got defaulted on. What most buyers can do is, seller can do is go back to that buyer and say, hey, you're defaulting on the loan. Let me give you a couple grand or something. Let's get this back in my name so I don't damage my credit. If you've got a non-flaky buyer, they'll probably do that. Benefits to the buyer, they have the tax benefits. When they do a lease option, they don't have the benefits of the interest payment, nor on the taxes. So there's a benefit to subject to, just like there is on assumption. Detriments to the buyer. It's risky. The loan can be called due if the lender is alerted of the transfer. The lender could make the borrower out or qualify in 30 days. The lender could not raise the interest. The lender could raise the interest rate and rate charges. The buyer could lose his down payment and costs if the lender says, hey, we're going to foreclose on you. We're going to exercise their due on sale. Do they generally do that? Sometimes. If they're smart, they don't. We had a great lender that I used to work with named California Federal in California. They're out of business now. And I sold a property that a client of mine bought. I sold it to another client of mine, customer of mine, and he took over the 9% loan. 2 years later, that buyer called, hey, Carl, I got a letter, and the seller called me, it was the same day, that the lender, they found out that the buyer and I'm making the tax payments, and they wanted to call the loan due. I called CalFed, got it into their customer service. They charged a $1,000 loan processing fee. They raised the rate from 9% to 9.5%. That's all they did. Lenders don't want these loans on their books as non-performing. So if lenders start processing loans for foreclosures, that becomes a non-performing loan for the lender. If they've got 10 loans at $30,000 or $300,000 that are non-performing, that's $3 million. The feds make them hold over three times that amount in deposits. So that eliminates the bank from having $900,000 that they can loan out. So what do the lenders prefer to do? Let's get this thing fixed. Let's fix this. Once again, I'm not an attorney. I'm just a practicing real estate agent that when I need to do this financing, I can do it. I know how to do it. It's benefit to other agents to know how to do this because you can help your clients that are in trouble, either buyers or sellers, specifically sellers. Why have them lose their equity? if there's optional ways to keep them out of trouble. Benefits to the seller when selling subject to. It gets rid of, I don't want it. I don't want that property. I'm done. I got divorced. When I see that property, I think of my ex-wife or my husband, my ex-husband, or my Aunt Sally. I want out of it. You have a relief from the payment, from your taxes, your insurance, your maintenance, it's all gone. So it's a benefit. I either don't want it and I don't want it, get me out of it. If you can wrap the loan, the seller can get a override on the interest. So remember we talked about the bricks, 1, 2, 3 bricks. So let's say there's a brick number 1 with the bank and brick number 2 with somebody else. And let's say this rate is say 4%, this one's 5%. So you blend the rate and you come up with maybe a 4.25 interest rate combined on both of those. That's a combined rate of both. So the seller says, okay, I'm gonna wrap the loan. I get this loan over for 50, this one for 70, or say 20, that's 70,000. I'm gonna loan out a total 100 by wrapping that 50 and the 20. So I'm gonna have a loan, a wraparound, all-inclusive deed of trust with the buyer for 100,000. I'm gonna charge him 6%. So then the seller, he gets a little override from that difference from the 4% to the 6% on that $50,000 and a little bit over on that $20,000. Then he makes the payment to the lender on the first and the lender on the second, and he keeps the balance. And there's ways, I'll share with you in a little while, there's ways to have those payments taken care of and done so either the lender doesn't find out about it usually, or you have control over it. Detriments to selling subject to the loan. The loan can be called. You're going to get credit damaged. You got to tell your sellers, hey, we could get caught on this. It's not illegal. I had another agent. I was in the Marine Corps. This fellow is now gone now in Dana Point. He was in the Marine. He was an elderly Marine from World War II, and he was a realtor. And I brought him an offer on a property that he had, subject to the loan. It was like a $400,000 house. The seller owed like $330,000 on it. I brought him $110,000 down. He said, no, you can't do that. That's illegal. I said, why don't you go to our broker? And no, that's illegal. I'm not going to do that. Guess what? Those people lost their house, just like the other party I told you earlier that my ex-wife's friends were. So did the agent do a good job for his people? Did he give them some options that they could have gone to an attorney and discussed? No. He cost them $100,000. Detriments to the seller. You have to make the payments, or you should if the buyer doesn't make the payments. So you can then you can go after him to get the property back, either in court or if you carried a second. And the second says he's going to make the payments on the first. He defaulted on the second. You foreclose on your second. Good attorneys know this stuff. It's not that challenging. It really isn't. The all-inclusive deed of trust. I kind of explained to you how that works. You take the first note, the second note, the third note. You wrap around it. Think about putting those bricks and putting aluminum foil or plastic wrap around them. And now you're going to make a payment on the whole amount. So you get the $50,000, the $20,000. You're going to loan out $30,000. That's $100,000 wraparound mortgage. So you're wrapping around the other bricks. The benefit to this as to opposed to contracts is with in our state, with a all-inclusive deed of trust, the parties are protected. The lenders are not alerted of the change in title. We also call an AATD a wraparound mortgage, all-inclusive TD, inclusive trust deed. There is a grant deed. That's the benefit. Great benefit to everybody. There's a deed that's given to the buyers. It's usually the wraparound mortgage, the AATD trust deed is recorded. You wrap the existing, a new loan to pay around the old loans. You promise to pay for the consideration you receive, which is a deed. You own it. When you go buy a car at whatever Chevrolet dealership and you finance the car, you don't get the deed. You got to pay off the car, and then they give you a deed. So there's a lien on your car. That's what you get when you do a contract. You have a promise to pay. You pay me on this 5-year contract at $850 a month for 5 years. I will then execute a deed. That's the difference between a contract and a trust deed. Now, I'm not sure if your state, if you have mortgages, if you do contracts only. I don't know if you record your contracts as we do our deeds. So this is relating more or the deeds to California. If you have a state that works with deeds, then you talk to an attorney and see what forms you use. So you wrap the loan. You're wrapping the $50,000 in this $20,000 loan. Contracts are called installment sale, land contracts, or land sale contracts or contracts. The deed's not recorded. You only have equitable title. The land sale contract is a covenant, a promise to a promise. I promise to give you a grant deed. You promise to pay me 9% interest rate for $200,000 for 15 years. In 15 years, or if you pay me off sooner, I will make a payment on the underlying note. In California, we can have what are called prepayment penalties. There's a limit that you can have on a prepayment penalty on a 1 to 4 unit building, a house up to 4 units. The prepayment penalty can only be 80% of the loan amount, and of that, 6 months interest. So you can't have a $50,000 prepayment penalty on a small loan. Why do people want to have a prepayment penalty? Because they don't want the loan paid off. Let's say that this all-inclusive deed of trust seller, he doesn't want the money. So he doesn't want to pay the capital gain now. He wants to defer that gain by either carrying back a deed of trust, which is cleaner than doing an all-inclusive deed of trust. But sometimes you do an all-inclusive if you have more than 1 or 2 loans. Does that make sense to you? So contracts of sale, there's no deed. All-inclusive deeds of trust, there's a deed. You have the deed. I prefer to do a transaction with the deed. I've done land contracts. Then you got to go track down the seller later, make sure they can sign off on a deed. Fire insurance issues. In most cases, the buyer assumes, takes over the existing fire policy. That policy, as you know, it goes to the lender. So what do? You put the buyer's name, as they have to be insured also, on the same fire insurance policy as the seller. So it looks like to the lender, when they get that policy the next year, it looks like that probably this owner borrowed some money junior to the bank's loan, and they're on as an additional shared person. If you are the buyer and you get yourself put on the property, and your insurance policy is not a homeowner's policy because you basically can't say you live in it, I suggest you get renter's coverage. So your furniture and stuff is covered in case of loss of fire or theft on your personal property. Talking about renter's coverage, if you are a landlord and this is just off the subject a little, and if you have a tenant that has a dog that would be construed as a violent type of dog or a breed, have them get renter's coverage. Why? If that dog bites somebody and your tenant's a flake, it has no assets, there's a lawsuit, sellers, you're the one with the equity, you're going to be in that lawsuit and you're going to be paying on it. So always make sure that your tenants have renter's coverage if they have any kind of a violent type of dog, and put that in your rental agreement that they have to have coverage. Collection and payment options. 4 types of payments. The buyer makes direct payment to the bank. How do you do that? With a money order. Go in and make the payment with the coupon. Cashier's check. Put the loan number on as a remitter, not your name. Or you can have the seller give you a bank account that he's been using, and he can put $100 in it. You give him as a buyer the $100, and he makes the payments to the bank with the check on the account. The buyer can make the payment directly to the seller, which is good, and the seller makes the payment to the bank. If you're on to the deed of trust as the override. Some neutral third parties make a living being collection agents. They'll make the payments. It could be a friend, a relative, for a small fee, a bank with a collection department. Some escrow companies do that. They make the payment, they disperse the payments to the parties that are the beneficiary of the loans that need to be paid. An escrow company can do it. That's sort of the safest way, is to have a third party do it. If you're a little concerned seller, I mean, it works, but it's just more paperwork. But then you have a handle on it. And if you do a deed of trust, you want to make sure that if you ever record a deed of trust, that you want to be notified if the first trust deed has a lack of payment. You can do that for a fee. It's called a tax service, and also for the taxes, it's called a tax service. So the advantage to each escrow party, it decreases the risk of alerting the lender. Or, like I said, the other thing I've done is, if it's done by automatic payment, then I just know the automatic payment password, and I just make the payment monthly, or I advise my buyers, just here's where you make your payment. Just start making a payment, and then get a copy of the return coupon or verification to the owner, the lender, the seller. So he knows that you're paid. So he doesn't have to come back and make the payments on the first and execute a foreclosure on you. Always, 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 and I'm going to share this with you now, even now for this class, the opinions expressed here are not to be construed as legal advice. Buyers, sellers, realtors should check with their own legal counsel and not take the advice of any agent or person, either expressly written or implied. The material is not an endorsement from the National Association, California Association. I'm now in the Palm Desert, California Desert Association of Realtors, or my brokerage firm, which is Windermere Real Estate and Estates. They're not endorsing this, nor is the California Department of Real Estate. Though I will say I did have this class approved from the Department of Real Estate for 5 or 6 years in the 90s. Remember, disclose. Disclosure on carryback financing. We in California, we have a form for it. It's mandated. I suggest that when you do the form, always get your operable operations manager or your broker to review the form. Make sure that they're happy that you did it correctly. The buyer's agent is the arranger of credit, not the listing agent. The buyer's agent, don't let them try to play with you and say, oh, you take care of it because you're the one said we have to do a $30,000 second. Buyer's agent is the arranger of credit. They should prepare the form, not you as a listing agent. Any and all financing should have a disclosure, except for one new loan that's done by the bank. The bank has their own disclosures. So be safe, even on an assumption. Do a financial disclosure. Disclose, disclose, disclose. I use the term early and often, E&O. Early and often is my term for errors and omissions insurance. Tell the principals to check with an attorney. And once again, reiterate everywhere your disclosure in your purchase agreement, your escrow instructions, you might want to take some time right now and work on your own handmade disclosure. You've got some examples earlier. You can go back on the YouTube and see it if you'd like, and make sure you put in the word not relying on. I have something I'll be sharing on another YouTube soon on buyer representation. Why do we work with buyers that make non-commitments to us when we have sellers who are signing contracts? Are we being fair? I'm going to share with you how to be a blue ribbon agent. That's my phone number. That's my website. I'm a member of the REBAC Council. New licensees, search realtor.com if you're or your MLS. If you're a private party, use our website to search for properties, not these other affiliate people that are out there banging around and making money off of our data. Go to realtor.com. You're going to get up to the minute information. When a listing agent puts something in the computer, it shows up immediately. It's not, I've had calls when people have gone to other websites, these ancillary websites, and they've called me on properties that were sold 5 or 6 years ago because they're going to some weird website to get the information that is basically taken from us as realtors, reprocessed, and resold for their profit. Crazy. The only thing constant in real estate is change. See you, be safe. My name's Carl Mitrak. If you like this information and you learned something, please hit the subscribe button. Thank you and be safe. If you're a realtor, I hope this helps you. If you're a private party, I hope you get a good agent in your neighborhood that knows it could look and knows associated alternative financing, and it works with you as a good broker, because believe me, with all these other people coming in the industry that watch Flip This House, they're going to last a year or two in the business. Small percentage of them. My license starts with a 005190085. Now our licenses are 02 blank blank. So it's probably been what, maybe 1,500,000 agents since I got in the business in 1975. And what's left now? I think we have maybe 300,000 agents maybe in California. So a lot of them have disappeared one way or another. Take care.